Thank you. So very welcome to this update with the SKAGEN Focus. It's me and David Harris presenting today, but I also want to highlight we have another team member in SKAGEN Focus, Jakob Rikvide. We hired him as an equity analyst in 2019. So we are 3 people running this fund of about 1.5 billion NOK as we speak. So it's been a pretty grim environment for value investing in general over the last 10 years, but in particular over the last 2.5 years, since mid 2018 sometime, there was the divergence between value assets and mega cap growth companies really diverged to an extreme level. And even 2020 was pretty bad for value assets in general. Although SKAGEN Focus did fairly well in that environment, or very well versus the value indices, and also beat actually the underlying benchmark in 2020 despite that really tough environment. We noticed a tailwind for value at the end of last year, and now it's stretching into this year. The question is, of course, can this last? We'll examine a few of those headwinds or tailwinds for the asset class in this presentation, as well as the portfolio structure and a few investment cases. So firstly, what is SKAGEN Focus about? Well, as you all are probably aware of, we demand a pretty substantial discount to our estimate of fair value to be interested in investing in the first place. We use a very conservative set of valuation parameters. We focus on identifying normalized or steady state earnings power and would like to derive our 50% upside at least versus that target. We have a 2 to 3 year investment horizon at the inception of any position. We are contrarian investors, and that means we're looking in areas perhaps where the not general interests are currently. And the best contrarian positions are not the falling knives. It's not the first page news on any newspaper. It's rather the forgotten, the ignored, or the below the radar type of assets that the SKAGEN Focus really focus on. And that is why we're so interested in global micro, small and mid cap companies. We're currently at about 85% in that area of global equity market. And in that area, these type of investment situations are much more easier to find than in the large and mega cap tech companies in the global equity markets. So being contrarian, what does that mean for us? Well, it means that we are trying to or want to identify certain patterns and certain phenomena which exist in global equity markets. And this takes a lot of training, of course. We've been doing this for a number of years, trying to sort of sort these phenomena out and really look for them in global equity markets. And for instance, looking at misunderstood assets, which is the first one we really would like to highlight for you, is one of our disciplines in this environment. And here we want to highlight a position in the fund, which is the only technology holding actually, which is Avaya Holdings. It's a $2 billion market cap holding, which is a player in the software services space, especially around call centers. This is, however, a hardware legacy company. They used to have a big hardware division. It's still perceived as a hardware company, although the recurring revenue is very substantial. And if we would value these conservative versus the peer group now, where these tech multiples stand, we see a substantial upside in Avaya Holdings. It's a 3% position in the fund. It's one of the best performing positions we have during 2021 so far, up about 70% Avaya Holdings this year. And also the ignored and the forgotten is of course very interesting for us. Things have been very bad for so long, so people don't really focus on these areas. And these areas constantly change, of course. Right now, we can identify these type of discounts, we think, in Japanese banks, for instance. And we hold a very interesting asset in Japanese banks in the form of Resona Holdings, which is one of the largest retail banks in Japan. This company is actually leading the consolidation or the potential consolidation of the Japanese banking industry, which is ongoing. It also trades on multiple, which are about 50% of tangible book value, despite delivering an ROE about 8 to 9%, we think, in the midterm, on par with most US banks, actually, which trades at 1 point its NAV or 1.5 times tangible book values. So the whole Japanese banking space is very interesting, but especially Resona Holdings in this reflationary environment potentially. And it's been one strong performer this year, about 30%. It's also a 3% position in the fund currently. We also have below the radar assets. And what do we mean by below the radar? Well, we basically mean assets trading without any coverage at all, very little knowledge from the general investor. And we have one such example we think is interesting for you, which is Canfor Pulp. It's essentially a stub trading in Canada. It's owned 54% by Big Canfor, which is the biggest lumber producer, one of the biggest lumber producers in Canada. And it's fairly liquid. It's these type of situations SKAGEN Focus can get involved in, since we're such a pretty small fund still. And it's a pure softwood pulp producer, trading at way below its normalized valuation levels, despite pulp now rising in excess of 40-50% in certain lines. Pulp is essentially the last of these raw materials to re-rate, we think, and it has not been discounted in Canfor Pulp. It's a position we have been buying, and it's about 2.7% of the fund currently in SKAGEN Focus. We also think temporary market dislocations are very interesting. Dieselgate being the perfect example, where you have an incident creating a sell-off in anything related to global cars and car production. That was of course uncovered a lot of interesting opportunities back then. Now we think we have a similar dislocation in financials, in traditional financials, such as banks, such as life insurance companies. These companies trade at exceptional discounts despite any tailwind from potential tailwind from the net interest income line, which could re-rate in this environment. And that's why we also have 25% of the fund in financials, in traditional financials. We'll take a look at that exposure in a while here on the next slide. So looking at the exposure to the fund, we mentioned we have a pretty substantial exposure towards financial. This is, however, nothing to be afraid of. These are all very discounted assets. They are also very diversified, which is the main point with this slide, to show you that these are very different geographies. These are companies in very different subsectors. There's necessarily no correlation between a Raiffeisen bank in Austria or, for instance, a Korean Re in South Korea. They are very company-specific drivers. Some of them have basically all of them have one common driver, which would be the yield curve. And we've seen a very interesting steepening of the yield curve, starting in the US and now actually moving into the global bond markets. So that is, of course, one systematic risk factor. That's why we use these risk factors in the first place to run the risk management system in the fund. We also have a very interesting situation in commodities, we think, where we have an exposure being both made up of precious metals, such as Rox Gold and Argonaut Gold, to gold mine producers. The gold price, of course, being the systematic factor here, as well as the input cost picture. These are generating substantial cash flows. But you also have these industrial metals companies like Edholm Mines, which is copper. And so the mix between all of these commodities, all of these basic materials, gives a very nice diversification within the basic materials and commodities exposure for the fund, which sits at about 30% of the fund currently.
So we're looking for value, and it's a price-driven investment philosophy. If we take a look at some of the cornerstones we use in our valuation process, we look at enterprise value, and here we look at the whole capital structure of the company and take into account all different financial obligations. We then look at the replacement value, trying to assess the underlying value of the company's asset base. And then we compare these against each other, and in this exercise, we're able to reach an interesting ratio between enterprise value and replacement value, which gives us useful information on the price that we are paying for the company's asset base. Then we spend time trying to understand the normalized earnings potential of the underlying company, and we do that over a cycle. And then we measure this against the equity hurdle, a discount rate where we are quite conservative. For a position to enter the fund, we require a substantial discount. We need to see an upside of at least 50% for a position to make it into the fund, and we also need to be able to identify clear catalysts that could support a re-rating within a 3-year horizon. So it's all about identifying value. We look for at normalized earnings power, which is why we rarely change our price targets, and we demand a substantial discount. Jonas spoke about opportunities that we can observe in the market, and here I wanted to talk about the spectrum in which we can apply our value-based investment philosophy. So if we start with mean reversion, which is perhaps the most known and classical form of value investing, here we have AirCap in the fund, which is a good example. It entered the fund last year. They're a global leader in aircraft leasing, and its share died together with the entire airline sector during the outbreak of Corona due to fear of balance sheet and liquidity risks. We have owned this company before. We made our own analysis, and that indicated that the company has sufficient funds and liquidity to navigate through a prolonged crisis and then a gradual recovery. And the shares have more than doubled since then. We actually, in fact, it reached our price target during the recent days, and we closed the position at that price target. And then we can take a look at economic return value. And here we try to identify companies that have a competitive advantage. And this could be due to certain assets. It could be due to industry positioning or brands. An example from the fund here right now is Roxgold. It's a Canadian gold miner, but with assets in West Africa. They operate with a cash cost, which is almost half of where the gold price is today, which enables them to produce substantial levels of free cash flow to fund their own growth, while it gives them a lot of abilities to maneuver. Then we have cyclical value, restructuring breakup value, and then I also want to highlight asset-backed value. So these are companies that are in position of hidden value or tangible assets. This could be real estate, land assets, mineral reserves, or cross-holding in other companies. Here I want to highlight as an example Canadian Edholm mines, which still is the largest position in the fund right now. They trade at very attractive valuations, especially if you take into account that they're now moving from being a developer towards a producer, which is why we have them as an example in this category. So their main asset, Kamoa-Kakula, is the world's second largest copper deposit. And this is in a world that desperately needs more copper to enable a green transition to happen. But still they trade at a substantial discount to NAV, especially if you look at how reserves are valued at larger peers such as Antofagasta or Freeport. And one company can of course be found in several of these categories. And these are just examples, some examples from the fund. But we also want to highlight that we try to diversify among the different types of value.
Yeah, so looking at the performance of the fund, it's now actually exactly 1 year since the COVID bottom in February, March were put in. And in terms of the performance of the fund, we've seen a very strong re-rating of the NAV since then. These are all numbers in euro, which is, so the fund is actually up over 90% in euro since this last year versus a benchmark, underlying benchmark of 40% for all country world. And we're especially happy with beating the all country value index, of course. Even in 2020, which was a very difficult year for value, the fund did really well. As I mentioned before, it's just the, let's say, the last few months that value really has caught a tailwind in terms of beating these value indices, beating the growth indices really. So, and there's reason to be optimistic on this going ahead as well, as we have a very fresh portfolio. Actually 53% are initiated less than 1 year ago. So the portfolio freshness, if you will, is really, and the portfolio upside to our price targets are still quite high, in excess of 40% currently. We also want to highlight that the structure of the portfolio or the valuation of the portfolio is really much lower than any of these indices, even the value index actually. And this is of course something that is interesting. We sort of have perhaps a more limited universe. However, of course, when the market's correct, our universe immediately expands since assets are getting cheaper. We also did rotate into many very interesting assets in the COVID crash 1 year ago. that's also resulted into several investment winners, like AirCap, for instance, being one of the examples David mentioned. But this is interesting. You'll see that we have a very cheap portfolio, if you will, compared to these other baskets of stocks. So this is a little bit the feeling, right, we've had since we have come back from the wilderness, if you will, since mid 2018 and onwards. Are there now reason to believe that we can have a sustained period of value outperformance? Well, we think there's several pillars that are now delivering strongly. And if we take a look at these items, I think one of the most interesting facts is, of course, that we have a very, very extended period of value underperformance. It's a unique depressed starting point for this movement to re-rate or go to mean reversion, if you will. This is basically built upon a massive monetary easing, which is already in place. We have also the potential or the actual confirmation of fiscal stimulus. Right now, for instance, the other day, the US launched another stimulus package, and we'll see probably more of these packages coming into play in 2021. And this is, of course, supporting the more cyclically induced value areas of the equity markets. We also think it's interesting that the vaccine is rolling out, and you're probably going to see a normalization in travel and leisure-related equity sectors, which we think is very interesting now to focus on in terms of normalization levels. You also see that the earnings growth rates of these cyclical value assets will post massive growth rates that would make even the growthiest company in technology fade, since we're now going to overlap the 2020 depressed levels, of course, which was the low point in this cycle. And if we look at the next slide, you'll see that the yield curve is taking the center stage here, because this is really how the markets try to price in this economic expansion. You know, the central banks are obviously in charge of the short end of the curve, being at zero in many geographies, but the market is trying to price in this economic expansion and inflation expectations going higher by taking up the longer bond yields. This is very good for financials. This is very good for traditional bank earnings, especially if this develops into a parallel shift of the curve. But also, if you take the other side of the coin, these mega cap tech companies with very high multiples on their earnings, this is going to be a headwind for those multiples to expand, since you're basically discounting these profits 10 or even 20 years out in the future, which is going to be compressed by the interest rate movements here. You also see these mega cap technology companies potentially facing antitrust, potentially facing a lower level of disruption rates and other things, the law of large numbers coming into play at the same time that value is having a re-rating. So the environment is really interesting at this point in time, we think. And they just want to show you how extreme this starting point is for this rotation. We managed to find this chart. This chart is actually from 1975, showing the value versus growth indices, and you'll see these blue areas, which is the growth outperforming section. We have that now for 10 years since the QE, essentially following the global financial crisis. You see that from 2001 and to 2007, there was a very good year for value, and even SKAGEN's funds had a really good run, I remember, back in the day. So we're now seeing this starting point extreme. So you'll see that the latest blip here, it's hardly visible on these charts, although it might have felt pretty dramatic and also visible in the numbers, of course, of SKAGEN Focus.
All right, so looking at performance year to date, the fund is up 11%. So we're off to quite a strong start here at the beginning of the year. Looking at some of the main drivers, we have Hitachi, our Japanese conglomerate, which has delivered very solid earnings results and also been executing on their transformation and the streamlining of their business, and still trades at a very substantial discount to fair value, we believe. A strong driver has been Avaya Holdings that Jonas mentioned before. And then I also want to highlight Parex Resources, which has benefited from higher energy prices a lot as they're a low-cost producer, but also they have proven their skill as very solid capital allocators. on the back of very strong free cash flow generation. They bought back 10% of outstanding shares last year, and they recently announced that they will buy back another 10% of shares this year, while they're increasing production and have a very strong balance sheet. So very interesting situation there. Taking a look at some of the detractors, Pasona Group, we will touch upon soon. And then if we look at Argonaut Gold and also Rox Gold, they have been impacted by the correction in the price of gold that we have seen. But we continue to see very strong fundamental drivers for both of these cases that trades at a substantial discount, and we see very strong catalyst for re-rating here. Also have to highlight Pasona Group, which is a 2.5% position in the fund. They're a leader in Japanese employment and staffing solutions, and this might be the cheapest stock out there. And it has recently gotten increasingly cheaper because Pasona owns a stake in Benefit One, and that stake is also listed. They own 51%, but that stake alone is worth 3 times the market cap of Pasona Group. And on top of that, they have a balance sheet, which is in a net cash position, and a core operation, which is profitable. So quite an extreme situation there, and they recently got new vocal shareholders, so there's a lot of exciting things going on there. Then I also have to highlight NLB Group, which is slightly above 2% of the fund. It's a Slovenian bank, and just an example of what we can find there below the radar, especially in the financial landscape. They're well capitalized and well diversified, but trading at half times tangible book for a normalized ROE, which is for a normalized ROE of 12%. The bank recently confirmed that they will pay out at least 300 million euro in dividends over the coming 3 years. And this can be put in relation to their market cap, which currently is around 1 billion euro. So quite attractive risk reward there, we think. Taking a look at the composition of the fund right now, we have 40 positions. You see our top 10 largest position there. We have touched upon most of them during the presentation. We have a very high exposure towards small, mid and micro caps, as we find a lot of opportunities in that part of the market right now. High concentration among top 10, 45%, and still a very substantial upside to our price target. And this is much due to the freshness of the portfolio, where over 50% of positions are less than 1 year from inception, as we have sold out positions that hit price target and replaced them, put money to work in new positions.
So just to sum up, we still see a massive potential for rotation into value from these higher multiple growth segments like the FANGs or the mega cap tech companies out there in this sort of reflationary environment. The fund performance has been very strong on a 1-year basis, beating essentially the world index by 50 percentage points and the value index by even wider margins. So very strong numbers on 1 year, although a shorter time period, of course. We have major exposures into commodities, which we have explained. That's a healthy mix between industrial and precious metals. Financials being also very diversified at 25% in different subsectors and geographies. We mentioned a few of these investment cases. On a geographic level, we are very heavy into Japan. We see very many interesting investment cases into Japan. We have about 20% weighting there, and Canada, where most of these mining positions are listed, all their assets sits usually in other places or jurisdictions. The target price potential here is in excess of 40% despite this rally in the NAV. So that's good news, of course, due to the freshness of the portfolio, 53% there being initiated less than 1 year ago. So I think we'll stop there and take any questions if there's any out there.
Indeed, there are, Jonas and David. Thank you very much so far. Now, we have a few questions about your mining exposure. The first one is, how do you assess that assess the risk that the Congo government will nationalize copper mines? I know that the Congo government has 20% ownership in Ivanhoe mines, for instance. What's your take on that?
Yeah, thank you very much. Yes, this is a very relevant question, and of course a key fundamental risk factor for the investment case of Ivanhoe Mines. together with the price of copper, of course. So DRC has a troubled past, and I think that this is the main reason why it trades at such a discount to peers. So in that perspective, it's reflected in the current share price through the discount rate that the people use to value Ivanhoe Mines. But there are a couple of things here that make us think this is unwarranted. There's a unique group of stakeholders in Ivanhoe Mines, and all with very strong incentives. So we have ownership of the main asset, Kamoa-Kakula, 20%, which is owned by the government of DRC. We have the founder of Ivanhoe Mines, an entrepreneur, Robert Friedland, which has a very solid track record, especially from situations like this. He owns 13% of Ivanhoe Mines. But there's a substantial Chinese presence. Zijin Mining owns 40% of the asset and also has a direct ownership in Ivanhoe Mines. And then we have CITIC Metals, which is China's state-owned investment vehicle that owns 26% of Ivanhoe Mines. And China is by far the largest source of copper demand. They are the largest buyer. So it's of great importance for DRC as mining export is their biggest contributor to GDP. And these are really world-class assets, we think. They have a high focus on sustainability and the development that stands out, and the progress so far have been really outstanding. But we also think that, looking at DRC, this is a once-in-a-lifetime chance for them to capitalize on the opportunity. They have been blessed with these high copper-grade deposits that are really needed right now in a world that wants to improve and sort of supply the green transition. This is a large country, young population, so the incentives are really there. But of course, it's all about cash flow and delivery, and I think the market needs to believe it and see it. So far the progress has been really solid, and we expect first production just in a couple of months in July. So we're quite excited about that.
Great, thank you. Now, another question is, what is your exit strategy from Ivanhoe Mines?
Yeah, well, it's we have our price target, of course, in Ivanhoe Mines being around 12 Canadian dollars, I believe, or at 1x NAV, basically. And we think, like David mentioned, there's plenty of fundamental drivers for the equity price to move from 7 Canadian dollars, where it is now, to 12 in the shorter term, even as the production now starts. And usually these assets starts to trade at around 1x NAV once the production is confirmed and starting up. And we don't see any necessary reason why Ivanhoe should be any different. It's currently the fund's largest position, as you know, about 7% of the fund. So we think these fundamental factors will obviously drive the share price up to, and this is not only liquid stock, this is a fairly liquid stock, and we can exit at our price target if we think that's appropriate at the time. There may also be some interesting speculation around the potential for Ivanhoe to be a takeout candidate, especially by the Chinese, maybe. But that's just speculation and nothing we have any additional information on, of course. But we think it will re-rate to our price target within the shorter term, and we will assess if we will exit this position or not.
Okay, thank you very much. Now, there has been a new question during the presentation, and it's about the Nordic names in pulp and paper. What is your opinion of these Nordic names, for instance, UPM, Kymmene, Billerud, Stora, etc.?
Yeah, we hold, we hold several assets in pulp. UPM Kymmene being one. We also hold Camphor Pulp, which we mentioned. We also hold Ence in Spain. So we have a pretty large exposure towards pulp. And we think the market has not really re-rated these equities in line with where the pulp market currently is trading. The market doesn't believe this re-rating in hardwood or softwood is for real, it seems. So we still have a lot of hefty exposure to this theme. I don't know, David, do you want to comment a couple of words on UPM?
Yeah, of
the
course.
Nordic name.
No, so we hold UPM, and first of all, overall, there's a high degree and focus on sustainability, and some of these Nordic names are really standouts in the industry, and UPM is one of them. We also like UPM. They have a very strong balance sheet, and they're able to fund their own growth. They're expanding quite substantially in terms of their pulp exposure to their mill in Paraguay, and they're able to fund this growth while paying dividends. So it's a very interesting capital allocation story there, together with the exposure they have towards pulp, which we think they will massively benefit from.